So those are the key stock valuation formulas that you need to know. We see that, as I mentioned before, it's more difficult to value than a bond because there's no promised cash flow. Unlike a bond, the bond promises you that coupon each and every year or twice a year, and that's promised to you over the life of the bond, whereas stock doesn't have that. There are no guaranteed dividends, and the life of the investment is forever. Common stock has no maturity. No easy way to look at that rate of return like you can with a bond. You can see what all other bonds in the market are paying. No easy way to observe that regarding stock. So the general stock valuation equation is simply present value of dividends in the future plus the price at some time in the future, price appreciation, and then discounting that all back to today. So that's the general method of stock valuation. Price of the stock today is equal to the present value of all future dividends. So I got to look at D1, D2, D3, D4, DT, and bringing that all back to today. And then also P sub T, but that P sub T falls off the end of the equation because it's just so far out. As you push P sub T plus one out, it just falls off because it's discounted by such a large factor. Dividend growth model, again, General Motors, there is no growth, so the G is zero. Stock can be viewed as an ordinary perpetuity, C over R, $2, $2, $2, $2, divided by the required rate of return. Again, similar to the present value perpetuity formula that we learned in Chapter 6. GM paid a constant dividend of $2, like I said, for many, many years. I think it was about 2008 when they finally reduced the dividend and finally canceled it altogether. They were in such a difficult economic environment. If there's an 8% required rate of return on the stock, what is the per share value? D over R, and the stock price would be estimated at $25 per share. Again, if that held, that does not hold any longer with General Motors. They don't pay a $2 dividend each and every year. Constant dividend growth, the dividend at any time t can be found by taking today's dividend times 1 plus that growth rate to the time. So dividend at time 4 would be today's dividend times 1 plus that 4%. To say if we want D4, it would be T. You plug in T4 in both places, and you can calculate that dividend very quickly. And similarly, if you have a constantly growing dividend, you can estimate the stock price by taking today's stock price times 1 plus that same growth rate to the time. Here's an example. Here's a corporation just paid a dividend of $3 a share. Dividend grows at a steady rate of 8% per year. What will the dividend be in 5 years? So in this case, T equals 5. So I take today's dividend of $3, growth rate of 8%, and put in a T of 5, and I get a dividend at time 5 of $4.41. So again, we can use Chapter 5 to help us determine future values of things like dividends. So very, very useful chapter. Dividend growth model is the model for a company like McDonald's that has a constant growth rate in dividends, growing at a steady rate. As I said, the board of directors at McDonald's once wanted to have their dividend grow 4% per year. So in this case, G would be 0.04. This model works if and only if R is greater than G. The required rate of return has to be greater than G, otherwise you're dividing by a negative number in this formula, and the model can't be used. So here's another example. If I want to find P4, price of stock at any time, in this case time 4, where growing at a 6% rate, the G is a constant 6% rate, required rate of return is 16%, I can find the price P4 equals D5. You can see that in the formula. P4, price at time 4 equals D5, which is D4 times 1 plus G, 1 year out beyond dividend 4. And I divide that by required return minus the growth rate, and I get a stock price of $50.50. And again, this would be for stocks that have a constant dividend growth rate. Supernormal growth rates may happen in business where the dividend grows crazily early on, and then it flattens out over time. They start growing at a more constant rate sometime in the future, and we step out 1 year. So if the rate changes after year 6, we stop at P6 and calculate P6. P6 would then equal D7 over R minus G. And we plug that into and you can see that at the bottom, P6 equals D6 times 1 plus G, or D7, divided by R minus G. And we plug this in for stocks that are growing at a constant dividend growth rate, G. Sometimes dividends grow in a two-stage model, where they grow at one rate, G1, then they grow at a second rate, G2. And you can use this formula, P0, stock price today, and then calculate that P sub t at the end of the equation by taking D sub t plus 1 divided by R minus growth rate 2. And this is the way we would use this formula in a two-stage growth scenario. Dividend yield is very, very important. It's quoted all over the financial press, and it's very, very important to investors, so you have to know how to calculate it. D1, next dividend, or full-year dividend, divided by today's stock price. So it's very simple. Capital gains yield, this is the other component of required return. When you buy a stock, you want price appreciation. So total R, total required return on McDonald's stock, is equal to dividend yield plus capital gains yield. Know this, it's very, very important. Separately, know how to calculate both dividend yield and capital gains yield. We'll go over how to calculate capital gains yield in Chapter 12. Stocks sometimes don't pay dividends. eBay comes to mind. For many, many years did not pay a dividend. How do we value that stock? Well, we can use some benchmark PE ratios or price to sales ratios to calculate an estimated stock price. How do you calculate the price of the stock today? P0 is equal to the present value of all the dividends plus the stock price at some time in the future. Again, if it's far enough out, it falls off the equation, as is shown here. What happens if you have a constant dividend payment like you had with GM? Back in the day, it's always equal to that C or D over R. And one can use the dividend growth model, use it when you have a company with a stock dividend growth rate that is constant.